So UPS has decided to scale back its contract with Amazon, and by 2026, they want to reduce it by 50%. Now, this news was met with, I would say, a little bit of opposition from investors when their stocks plummeted significantly ever since the announcement has been made. Now, let's take a look at what UPS has to say about this major change.
First up, we want to take a look at UPS. You're looking at shares off just about 17% right now. Investors looking for some evidence, more evidence they want to see of its efficiency plan is starting to take effect. The company is forecasting a downbeat 2025 revenue as deliveries from its largest customer, widely believed to be Amazon, is expected to be cut in half. Joining us now, we want to bring in UPS CFO Brian Dykes. Brian, it's great to have you back here on Yahoo Finance. Let's start with the Amazon part of the business. So something your team highlighted to us as well. I'm curious just how investors is clearly concerned here when you take a look at the reaction in shares here today. How should investors then be looking at that, and why is that? Is that a strategy that makes sense for UPS?
Well, first of all, good morning. It's a pleasure to be here. Thank you for taking the time. So today one of the things that we announced was a strategic decision for us to start to glide down some of the volume from our largest customer over the course of the next 6 quarters. Now, when you look at the holistic package of what we announced today, from taking control of service on our SurePost product, the glide down of our largest customer, and also some of the efficiency programs we have, they're all about taking control of our own destiny. Specifically around our largest customer, we've made the decision that we want to be able to manage our assets and our resources in the areas of the market where we can, quite frankly, drive higher yields and returns. And so the result of this is that we will be taking volume down and we'll have revenue down in 2025 and 2026. But it improves the margin in every quarter in 2025. We'll see about 130 basis point improvement in our U.S. business where this is occurring. And we see that putting us on a path to much higher margins as we get into 26 and beyond.
Brian, that largest customer, if I'm understanding it correct, would also probably be a competitor in this space too, right? And I'm wondering if some of the investor question here is, could they become, or I guess, gain more market share and sort of be more competitive against UPS? Is that a concern in any way with this move?
So look, we've had a 30-year relationship with Amazon, and this is a collaborative effort because, quite frankly, with the amount of volume that we're talking about moving, it has to be an orderly transition, or else it would impact both their customers as well as our residual customers. And they will continue to be a customer of ours for the long term, but the portion of the business that we're transitioning out of just doesn't make sense for us to do. If you think about Amazon and their delivery, they're really an integrated retailer, right? And they're delivering stuff that sits in their fulfillment centers. We also deliver stuff from other people's fulfillment centers, but they have built their own capability to do it. So from a competition standpoint, we actually still help Amazon with a lot of the things that make sense with our network, which is built for long zones, multiple pickup locations, and moving things across the country, versus theirs, which is built for much shorter fulfillment center to door network capability.
Brian, given the results and given the larger trend that we're seeing just in terms of a slowdown here in volume, what's the pricing strategy then?
So if you look at the underlying business, excluding what we are doing with our largest customer, we're still growing. We're actually growing in the places where it matters most to us. And we've invested in capabilities to do that. So our DAP program, which helps SMBs facilitate e-commerce, is reached over $3 billion last year and continues to grow at double digits. We're investing in healthcare and closed another healthcare acquisition in Europe that provides cold chain transportation capabilities. And so our underlying business, both in the US and our international business and our supply chain business, continues to grow, and we're really pleased with the pace of that growth and the returns we get from it.
Brian, are you thinking about raising prices though again?
So we've had a lot of pricing discipline that's gone in the back half, and I would say it's less about raising prices and more about being smart about prices. We've invested a lot in pricing science technology, and now when we call them bids, but pricing activity, 96% of our pricing bids for our small business customers go through our AI technology that allows us to do it faster, more accurate, and really be smart about how we price so that we can drive revenue efficiency, but also drive value for our customers.
Brian, I'm curious, just from a broad perspective, I think one of the investor questions here is just the turnaround story, right? And when we're going to really fully start to see it in the results, in the numbers. I mean, how do you sort of view that timeline for the turnaround story? What should investors be expecting from that perspective?
So it's immediate, right? And this is already well underway. What I would say is, if you look at the fourth quarter, our initial estimates that we would exit December at a 10% margin. We had a 10% margin for the quarter because of great cost management, pricing discipline, and our ability to continue to win volume. As we go into the fourth quarter, even with the volume decline, we will expand margins in every quarter of 2025, and we expect that to accelerate in 2026. So this is not a wait for it to come story. This is it's happening now, and we're moving quickly. We're taking control of our business, and it gives us the ability to now drive margin and growth in the areas of the market where we really want to focus.
So it sounds like UPS has just faith in themselves, and that even though Amazon is a large conglomerate of a company who obviously needs more trucks on the road in order to supply their customers with all of their products, UPS is saying that, look, this is not what we started business for. So as much as we appreciate Amazon giving us the opportunity, we think we can do some things on our own. The investors, on the other hand, obviously may not see how this can be as profitable for them since, like he said, Amazon is their largest contract. And so we'll see how this turns out. Just because UPS believes in themselves doesn't mean that the customers as well as the investors also see the same vision. So I think they just need some time to prove themselves. I don't know what this means for Amazon Relay as well, since UPS was moving a lot of the freight for Amazon. Maybe that now opens up more opportunity for the carriers who work with Amazon to have an opportunity to come in and run some Amazon or run more Amazon now that UPS will be cutting back on the freight that they run for them. So we'll just see, time will tell, and we just hope that, UPS is on the right direction with their vision and that it doesn't completely destroy their company by taking away one of their biggest contracts.